Good morning, I am Kevin Price. Delighted to be with you. Going to spend some time talking to you about you and your business. Going to spend some time with Brian Domitrovic. He's been a guest before on the program. Love to get him on to talk about what's happening on the economic front, and he brings a unique perspective as an economic historian. He's a PhD and a professor over at Sam Houston State University and chair, in fact, of the history department. Plus, he's a writer for Forbes.com. Brian, welcome back.
Kevin, it's great to be here.
Yeah, and my understanding is we're going to try to keep you for two segments today because we got two topics, if that works for you.
That's perfect.
Yeah. First topic I thought we'd bring up is the oil prices are plunging. And what does that mean for consumers? Let's talk a little bit about that. Anyone who drives, and this show's mainly in Houston, but it's going to be rebroadcast on the national news website, usdailyreview.com. And so it's going to, it's going to be seen elsewhere. And the reality is that it's good for some places more so than others. True?
Yeah, I think it's a pretty unalloyed good, Kevin, I have to say, in that the price of oil represents the degree of confidence in the dollar, and it's always tracked the price of gold for that reason. So when the price, it's an inverse relationship. When the price of oil falls, that means people are more and more confident in the dollar, and usually that means that there is a rush of investment into all non-oil sectors in the economy. So whatever suffering there may be in the oil sector of the economy, the energy sector, all other areas of the economy will see a benefit.
So this is kind of analogous to what happened in the 1980s when the oil economy collapsed under Jimmy Carter, but prosperity broke out throughout the rest of the country.
Yeah, precisely that. So any region of the country that has an even slightly diversified economy away from the energy sector will see a boom. And I expect that to happen in this case. The one thing I am concerned about is that there has been a little bit of a divergence between the price of oil and the price of gold. Usually there's a 15-to-1 relationship between an ounce of gold and a barrel of oil. That's increased to about 20-to-1, maybe a little higher. And that might mean that oil is not exactly serving as that barometer like gold is. Maybe there is oversupply from Saudi Arabia and places like that. So maybe gold is signaling that the Fed isn't doing that great, and maybe government's staying a little too large. I'm not sure.
Yeah, well, I would say there's plenty of evidence of that.
Mm-hmm.
No question about that. Tell me a little bit then, on looking at it going forward. Again, Houstonians, I'm concerned that, of course, we're not nearly as dependent on oil today as we were in the mid-1980s. Over 70% of the Houston economy was oil-driven in the 1980s. But I am a little bit concerned about, what's going to happen here locally in the greater Houston area or the state of Texas.
Yeah, I mean, there's one big benefit. I'm actually going to be writing about this on Forbes.com next week. There is one singular benefit, and that is that this collapse in the price of oil happened just before the legislative session, which happens every 2 years, was about to open. So that means the government of Texas, the state legislature, cannot project massive revenues on the basis of high oil prices. That could mean, let's hope, that there will be a really tight rein on government spending from Austin this year. And if that's the case, we can expect the Texas economic miracle to continue.
Okay, that'll be interesting. It'll be interesting because you got a whole new cast of characters dealing with these issues.
Mm-hmm. Yeah, I mean, 2 years ago, the Senate Finance Chairman, Tommy Williams, he kind of got run out of town because they spent a little too much money. So I do hope, especially with the new governor, that there's an atmosphere of chasteness. And let me tell you, I mean, California is the model, the anti-model. If you keep spending down in an economically vibrant state, you will continue to run and run and run, and Texas has that before it.
Mm-hmm. Yeah. So anytime you can get the activity out of the public sector and into the private sector, it means growth.
Yeah, sure. That's way more important than the price of oil. Let me assure you of that.
Oh yeah, I agree with that. So I'm intrigued by your thoughts that you're seeing a signal with the price of oil of a more robust dollar. I can't help but attribute it to things like Saudi Arabia, the bizarre form of competition happening from Russia, the incredible power of fracking. There's nothing about our dollar that would make me think that people wouldn't perceive it as robust.
Yeah, there is that divergence again. I mean, usually, the price of oil, the gold is about $1,200 an ounce. So that implies, divided by 15, probably a price of oil around $60 or $70 a barrel, and yet oil's at 46. So I think that price of oil down to 46 from about 60 or 70 is probably the super supply that's coming from Saudi Arabia. Now, however, I do think that the Federal Reserve is a little chastened. I think Janet Yellen has become a little bit intimidated by her job, and Barack Obama is a lame duck. So I think the markets are understanding that the really big push for big government, Obamacare has trouble in the courts now, the really big push for big government is behind us. And if you had to take a bet on the future, it will be a stronger dollar and a more modest government.
Mm-hmm. Interesting. Brian Domitrovic. By the way, tell us a little bit about the works you've done, published work. You have a relatively new book out there included, and that I'd like you to talk a little about.
Yeah, sure. Arthur Laffer, the author of the most famous economics graph of the last half century, we just celebrated the 40th anniversary of it. I published a collection of his work and the work of the people in his firm called The Pillars of Reaganomics. It's got 10 articles from the supply-side tradition under Arthur Laffer from 1980 to 2005. So you can see how the supply-siders, as Arthur Laffer called his group, made their running commentary of the unfolding Reagan Revolution is really spot on every time. And it's kind of a manual about how to think about economic policy during times of stagflation and getting out of it into a huge boom. The Pillars of Reaganomics, just published in October.
Yeah, very cool. And encourage people to check that out. The Pillars of Reaganomics is really an excellent book, bringing a lot of different perspectives from people with firsthand knowledge. So very good. So, and by the way, you're starting your new class. When does that begin?
Yeah, it begins 2 weeks from today, so that's the 26th. So it'll be a seminar on the primary documents of the supply-side revolution, and I happen to have in my possession the personal papers because he gave them to me of a man named Alan Reynolds, who coined the term supply-side economics back in 1976. And he was the one who convinced the Wall Street Journal that they had to stop opposing tax cuts. The Wall Street Journal opposed tax cuts for its entire history until 1977. And he was really instrumental in doing things like helping Kemp Roth become the Reagan tax cut of 1981.
Yeah, I got to meet Alan Reynolds, by the way. I think he's now at the Cato Institute, and he's absolutely brilliant. Mm-hmm. So that's
and he's in the last 10 years he's made his mark arguing against Thomas Piketty and Emmanuel Saez about this top 1% stuff that had been going on even before that book was published last year. And so he's been Johnny on the spot now for 40 years.
Yeah, he certainly has. Brian Domitrovic, we're going to continue our conversation with him. More sad news for United States when it comes to the economic freedom indices. We'll be talking about that and more right here on The Price of Business. Stay tuned for more.